78.5 million ounces. That is what remains in registered COMEX silver vaults as of this morning's warehouse report. Another 1.5 million ounces were pulled out in a single overnight session. And while that number was printing, two contradictory signals were coming out of Washington and the Pentagon simultaneously. And the silver market just told you, in no uncertain terms, which one it believes. This is not background noise. This is real-time capital flight from paper into physical metal. The data that moved overnight changes the risk picture for every silver holder watching right now. And I want to walk you through exactly what happened, because no single headline captures the full sequence of events. Let's go back to Wednesday afternoon. A statement from the White House suggested the conflict with Iran was close to resolution, that a deal could come very soon. Oil dropped sharply on that news, falling roughly 10% from elevated levels. The dollar pulled back. Silver initially spiked on the dollar weakness, touching the upper 80s before settling into a consolidation range. For a brief window, the market read that as a de-escalation signal. Some traders took profits on their safe haven positions. Risk appetite returned. Then, at around 8 o'clock Wednesday evening, the Pentagon released its operational summary. U.S. forces had conducted what the military described as the most intensive strikes yet against Iranian drone manufacturing facilities, missile storage sites, and naval assets in the Persian Gulf. 23 targets struck across a 6-hour window. A Navy destroyer intercepted 4 anti-ship ballistic missiles launched from Iranian territory toward commercial vessels attempting to transit the Gulf of Oman. The Strait of Hormuz, the waterway that carries roughly 20% of global crude oil and enormous volumes of liquefied natural gas, remains effectively closed, operating at just 5% of normal capacity. More than 150 commercial vessels are anchored outside the strait, unable to move. Insurance companies have declared the entire Persian Gulf a war exclusion zone. Any vessel that enters does so without coverage. The gap between the White House's optimism and the Pentagon's operational tempo created what overnight trading desks described as a credibility vacuum. The market doesn't know who to believe. And when that happens, markets do the only rational thing available to them. They buy the one asset that doesn't depend on anyone's credibility. They buy physical metal. Overnight COMEX silver volume between 8 in the evening and 6 in the morning Eastern surged to 34,000 contracts. That is 170 million ounces of notional silver changing hands in a session that typically produces 8 to 12,000 contracts. The buying came in 2 concentrated bursts, the first between 8:30 and 10 at night, corresponding to the market absorbing the Pentagon briefing, and the second between 2 and 4 in the morning, coinciding precisely with the Shanghai and Mumbai market opens. That second window is the story underneath the story that most analysts are not yet connecting to silver. Let me ask, where are you watching from right now? Drop your country or city in the comments. I want to know how far this conversation is reaching, because what I'm about to cover affects precious metals markets from Seoul to Jakarta to London, and it matters where you're positioned. In the 12 days since U.S. forces struck Iran, 3 separate banking stress events have emerged across Asia, and each one is feeding directly into physical silver demand. South Korea's financial regulator confirmed Wednesday night that deposit outflows from the country's 4 largest commercial banks accelerated to 11 trillion won in March alone. That is approximately $8.2 billion leaving the Korean banking system in 10 days. The Korean stock market fell 18% in a single session last week. Korean citizens are not moving money to other Korean banks. They are converting won to dollars, gold, and silver. The Bank of Korea burned through $4.7 billion of foreign exchange reserves in 1 week, trying to stabilize the currency. The won hit its weakest level against the dollar since the 1997 Asian financial crisis. India is experiencing a parallel stress event. The rupee broke to 92 against the dollar overnight, setting a new all-time low. The Reserve Bank of India has reportedly spent approximately $12 billion defending the currency since the Hormuz closure. Indian bank customers are withdrawing cash and converting to gold and silver at rates not seen since the 2016 demonetization crisis. Silver futures on India's MCX surged sharply earlier this week and continued higher through Wednesday. Indian physical silver imports for March are on track to set an all-time monthly record in Indonesia, The central bank intervened in currency markets 3 separate times on Wednesday, as the rupiah dropped to 16,800 against the dollar. Retail gold and silver dealers across Jakarta, Surabaya, and Bali reported selling out of inventory entirely. The Indonesian government is reportedly considering capital controls to stop the outflows. Point 3 banking systems. 3 currency collapses. 3 simultaneous surges in physical precious metals buying. This is not coincidence. It is the predictable response of populations who have lived through currency crises before and know from generational experience what happens when paper money loses credibility. They don't convert to crypto. They don't move into treasury bonds. They convert to the physical asset their grandparents held through every prior crisis: gold and silver, something they can hold in their hands. And here is where this becomes structurally critical for every silver investor watching today. Every ounce purchased by a Korean, Indian, or Indonesian citizen is an ounce that does not reach Western dealer shelves. Refineries in Singapore, Perth, and Switzerland that would normally export to American and European dealers are selling locally at premiums that Western buyers simply cannot match. Shanghai physical silver premiums reportedly reached $13 to $15 above COMEX spot prices this week. When an Asian buyer is willing to pay that kind of premium, the refinery does not ship to America. The metal stays in Asia. 3 billion people watching their currencies erode are redirecting the global physical supply pipeline at its source. The COMEX data confirms this pipeline disruption in real time. Registered silver inventory has now fallen 59% since October of last year. In just the last 30 days, total COMEX inventory has declined by 44 million ounces. Each remaining registered ounce now sits behind approximately 7.3 paper claims, based on total open interest exceeding 560 million ounces. In March alone, more than 33 million ounces have been physically removed from COMEX vaults through the delivery process. The May delivery cycle is the next critical pressure point, and this is where the numbers become genuinely alarming. Over 77,000 May contracts are currently open, representing 387 million ounces of paper claims. If even 15% of those contracts stand for physical delivery, that is 58 million ounces of demand pressing against a registered base that will be below 70 million ounces by end of March at the current drain rate. That would produce a coverage ratio of approximately 1.2 to 1. The exchange has never operated at that level. There is no existing playbook for this scenario because this scenario has never occurred. Backwardation confirmed again in Wednesday's session. Spot silver is trading above futures prices for forward delivery months. The spot premium over the May contract continued to widen. Lease rates remain elevated at 5.6% annualized. These are not normal market conditions. Backwardation means industrial buyers are paying more for silver today than for silver 3 months from now, because they do not trust that silver will be available 3 months from now at any price. Lease rates at 5.6% make it uneconomical for refiners to hedge during processing, which in turn breaks the scrap recycling supply chain and removes a key secondary source of supply from the market. Now let's layer in the macro backdrop, because it compounds everything else. Wednesday's CPI report printed headline inflation at 2.4% year over year, with core at 2.5%, both in line with expectations. Inflation is running sticky above the Federal Reserve's 2% target, but not accelerating sharply. The market's reaction was muted on the inflation side, but significant on the rate outlook. With the inline print, the Fed has no urgency to raise rates, but also no clear catalyst to cut. The March 18th FOMC meeting is 6 days away, and the Fed is currently in its pre-meeting blackout period. Markets are pricing a 73% probability of a hold and 27% probability of a cut. For silver, this creates what analysts call a stagflation setup, the precise macro environment where precious metals have historically performed best. The economy is softening, with unemployment running above 4%. Inflation is sticky above target. Oil is still roughly 40% above pre-conflict levels even after the recent pullback. That elevated energy cost is feeding through supply chains into producer prices, and this morning, producer price index data for March is being released. If that number prints hot, confirming that producer costs are accelerating from the oil shock, the stagflation narrative solidifies and silver tests the $90 threshold. If it prints softer, rate cut probability rises, the dollar weakens, and silver is pushed toward 90 from the opposite direction. Every plausible PPI outcome points the same direction. The shipping data reinforces the inflation feedback loop. Major container carriers have imposed emergency conflict surcharges of $2,000 to $4,000 per container for any route touching the Persian Gulf or the Indian Ocean. These surcharges are contractually embedded for minimum 60-day periods. Even if the strait reopens tomorrow, those additional costs remain embedded in the supply chain for 2 full months. Every silver bar shipped from a Singapore refinery to a London vault now costs materially more. Every solar panel component transiting the Indian Ocean carries embedded logistics inflation that feeds directly into the next round of CPI and PPI data and keeps the Federal Reserve in exactly the position it finds itself in now, unable to cut without reigniting inflation, unable to raise without breaking an already fragile economy.